$338 trillion. To the human mind, a number of this magnitude is effectively abstract, a figure so vast it loses its tether to physical reality. To understand it, one must look not at the currency itself, but at what it represents in relation to the productive capacity of the entire human species. This figure, the total accumulated debt of governments, corporations, and households worldwide, now eclipses the global gross domestic product by a margin that has historically signaled not just a recession, but a fundamental breaking point in the financial architecture. We are currently operating in a global economy that requires nearly $3.50 of new debt to generate just a single dollar of growth. This is not merely a balance sheet anomaly, it is a mathematical divergence that challenges the very premise of perpetual economic expansion. For decades, the global financial system has operated on the assumption that tomorrow's growth will always be sufficient to pay for today's borrowing. But when the ledger reaches $338 trillion, the mathematics of compound interest begin to consume the machinery of the economy itself, turning the promise of future prosperity into a systemic threat that few are willing to acknowledge. Most observers view debt as a simple transaction, money borrowed today to be repaid tomorrow. In the public consciousness, this figure is often dismissed as just paper money, or a problem for future generations to solve. There is a prevalent belief that because nations like the United States or Japan borrow in their own currencies, the debt essentially does not matter, or that central banks can simply print their way out of any obligation. This perspective, however, misses the critical distinction between liquidity and solvency. While a central bank can provide infinite liquidity by creating currency, it cannot create value. The $338 trillion mountain of leverage is not just a pile of money owed. It represents a claim on future labor, future resources, and future taxation. When those claims exceed the realistic output of the global economy, the market begins to realize that not every promise can be kept in real terms. The tension we see in bond markets, the sudden spikes in yields, and the desperate search for safe collateral are not random fluctuations. They are tremors in the foundation of a system attempting to reconcile infinite financial promises with finite economic reality. The origins of this accumulation lie in a profound shift in monetary philosophy that accelerated following the 2008 financial crisis. Faced with the prospect of a deflationary collapse, central banks embarked on an experiment of unprecedented scale, suppressing interest rates to near zero and, in some cases, into negative territory. This era of cheap money incentivized borrowing on a scale never before seen in human history. Corporations borrowed not to invest in factories or research, but to buy back their own shares, artificially inflating stock prices while degrading their balance sheets. Governments borrowed to fund deficits without the political pain of raising taxes. Households borrowed to maintain standards of living amidst stagnant real wages. For over a decade, the cost of carrying this debt was negligible, masking the growing structural fragility. But the era of free money has ended. As interest rates have normalized to combat inflation, the cost of servicing this $338 trillion burden has surged, creating a shockwave that is moving through the plumbing of the global financial system. We are now witnessing the arrival of the refinancing wall. A vast portion of this global debt was issued with short-term maturities, predicated on the gamble that rates would stay low forever. As these bonds and loans mature, they must be rolled over at significantly higher interest rates. For a corporation that barely survived on 2% interest, refinancing at 6 or 7% is an existential crisis. This creates a phenomenon known as the zombie economy, where a significant percentage of companies generate only enough cash flow to pay the interest on their debt, leaving nothing for investment, innovation, or wage growth. These entities are effectively dead, kept animated only by the flow of credit. As credit conditions tighten, the life support is withdrawn. The result is not just a series of bankruptcies, but a slow suffocation of economic dynamism. Capital that should be flowing toward new technologies and productive enterprises is instead trapped in the past, servicing the liabilities of yesterday. The sovereign debt component of this $338 trillion figure is perhaps the most precarious. For centuries, government bonds, particularly those of developed nations, have been considered the risk-free asset, the bedrock upon which all other financial risk is calculated. However, when the debt-to-GDP ratios of major economies push beyond 100%, 120%, or even 250%, the definition of risk-free comes into question. We are seeing the early stages of a sovereign funding stress test. As governments continue to run deficits, they must issue more debt to cover the shortfall. But the buyers of this debt, pension funds, foreign central banks, and institutional investors, are demanding higher yields to compensate for the risks of inflation and currency debasement. This creates a vicious feedback loop. Higher yields mean higher interest payments for the government, which leads to larger deficits, which requires more borrowing, which pushes yields even higher. In this environment, fiscal policy becomes paralyzed. Governments find themselves spending more on interest payments than on defense or education, forcing a choice between politically suicidal austerity or the inflationary monetization of debt. This dynamic explains the frantic movements we see in the currency markets. Capital is no longer just seeking return, it is seeking preservation. When a nation's debt burden becomes unsustainable, the market anticipates that the only way out is through currency devaluation, paying back creditors with money that is worth less. This leads to capital flight, as investors move their wealth out of vulnerable jurisdictions and into assets that they perceive as stores of value, whether that be the US dollar, gold, or hard commodities. The exorbitant privilege of the US dollar allows the United States to sustain deeper deficits than other nations, but even this privilege is not absolute. The sheer volume of Treasury issuance required to fund U.S. liabilities is testing the market's appetite. When auctions of government debt show signs of weakness, or tails, it is a signal that the global pool of savings is becoming saturated. The system relies on the assumption that there will always be a buyer for sovereign debt. If that assumption falters, the central bank becomes the buyer of last resort, a move that signals the end of fiscal discipline and the beginning of outright currency dilution. We must also look at the hidden leverage within the shadow banking system. Much of the $338 trillion figure is transparent, reported on balance sheets and in regulatory filings. However, a significant portion lies in opaque derivatives, off-balance sheet vehicles, and private credit markets where the true extent of leverage is often obscured. This shadow debt creates a web of interconnectivity that is difficult to map until it begins to unravel. In a highly leveraged system, the failure of a single counterparty can trigger a cascade of margin calls and forced liquidations. We saw glimpses of this during the liquidity crisis of 2020 and the banking stress of 2023. These events were not isolated accidents. They were symptoms of a system that has become too rigid, too tightly wound by debt to absorb shocks. When leverage is high, volatility is suppressed until it explodes. The calm surface of the market often belies the immense pressure building underneath, where collateral chains are stretched to their breaking point. Historically, debt supercycles of this magnitude have rarely resolved themselves without significant upheaval. If we look back to the post-World War II era, advanced economies carried massive debt loads, but they were able to grow their way out of them through a combination of rapid industrial expansion, favorable demographics, and regulated financial repression, where interest rates were kept artificially below the rate of inflation. Today, the conditions are markedly different. Demographics in the developed world and major parts of the developing world are turning unfavorable, with aging populations shrinking the workforce and increasing the burden on social safety nets. Productivity growth has stagnated in many sectors. Without the tailwind of rapid demographic and economic expansion, the growth solution becomes mathematically impossible. This leaves policymakers with a limited set of grim options: default, which would trigger a global depression; austerity, which would trigger social unrest; or inflation, which transfers wealth from savers to borrowers by eroding the real value of the debt. The path of least resistance for political and monetary authorities is almost always inflation. It is the invisible default. Rather than telling a bondholder they will not be paid, the system pays them in full with currency that commands less purchasing power. This is the hidden tax levied on every holder of cash and fixed income assets. It is the mechanism by which the real value of the $338 trillion is reduced to a manageable level relative to GDP. We are already seeing this strategy in motion, whether officially acknowledged or not. Central banks may talk of 2% inflation targets, but the structural necessity of the debt burden suggests that higher average inflation may be tolerated, or even engineered, for years to come. This creates a bifurcated reality where asset prices, stocks, real estate, collectibles, rise in nominal terms, creating an illusion of wealth, while the real purchasing power of wages and savings quietly evaporates. The implications for the banking sector are profound. Banks are stuffed with assets vulnerable to rising rates, government bonds and commercial real estate, shifting the model from productive lending to collateral-based speculation. Central bank backstops effectively nationalize this risk, preserving immediate stability while guaranteeing long-term moral hazard. Geopolitically, this debt burden is fracturing the global order. Emerging markets, crushed by a strengthening dollar, are forced to cut services or turn to rival powers for bailouts. As debt diplomacy becomes a tool of statecraft, nations are accelerating the search for alternative payment systems, challenging the dollar's hegemony and adding a volatile new layer to the financial landscape. This $338 trillion figure is not static. It grows relentlessly while the global economy struggles to keep pace. The efficiency of debt has collapsed. Borrowing that once fueled growth now suppresses it, creating a financial parasite that drains the real economy. Smart money sees this endgame and is already shifting from government bonds to real assets, infrastructure, commodities, and land, prioritizing the return on. In contrast, the average individual remains dangerously exposed through pension funds anchored in these devaluing debt instruments. If these funds falter, the burden falls back on the state, completing a vicious cycle. We are facing a future where the social contract is renegotiated not by legislation, but by market forces, as the promises of a low debt era collide with the mathematical impossibility of a high debt reality. Ultimately, this $338 trillion burden acts as a ceiling on global potential. When the credit card is maxed out, the capacity for nations to maneuver during crises, wars, pandemics, or ecological shifts simply vanishes. We are entering a painful period of deleveraging where policymakers face a grim binary, a deflationary depression, or an inflationary grind. History suggests they will choose the latter, eroding the real value of debt by relentlessly raising the cost of living, widening the gap between those who hold assets and those who survive on wages. This threat goes deeper than a market crash. It is the slow disintegration of trust in money itself. We are transitioning from a system based on infinite credit to one bound by hard constraints, where the volatility in the markets is simply the sound of reality reasserting itself. To navigate this, one must look past the illusion of nominal stock highs and understand that this debt mountain is the defining feature of the next decade. Ignoring it does not make it disappear. It only leaves one unprepared for the moment when the bill finally comes due.